Welcome to the deep dive. We're here to cut through the noise and get straight to the insights that matter most to you.
That's the goal.
Today, we're diving deep into Lennar Corporation. That's ticker LEN. We've got a really interesting analysis here from stocktelescope.com.
Mm-hmm.
Now, before we get into any of that, the usual but very important disclaimer. This deep dive, like all of them, is purely for informational and educational purposes.
Absolutely.
It is not investment advice. Please do your own research. Talk to a licensed financial advisor before making any decisions.
Right. And our mission today really is to unpack this strong buy rating Stock Telescope put on Lennar.
Yeah.
It's the nation's second largest home builder, and they're calling it a compelling contrarian opportunity.
Yeah.
Which is interesting given, all the headwinds in housing right now.
Exactly. And hey, if you want to keep getting these kinds of insights, these deep dives into source material, make sure you hit subscribe for the deep dive. Don't miss out.
Definitely worth it.
All right, so let's jump in. Stock Telescope kicks off highlighting Lennar's valuation, calls it compelling.
Right.
It's treating, get this, at just 7.95 times trailing earnings. Now, that sounds low.
It is low, but the key thing they point out is how, cyclically depressed that number is, meaning the market's pricing it like this housing downturn is like forever, not just a temporary dip.
Ah, okay. So it creates this potential entry point, almost historic, they say, for patient investors. Does that track with what you see?
It really does. I mean, look, the stock's down 47% from its peak. That screams pessimism, maybe overly pessimistic sentiment, as the source puts it.
47%. Wow.
Yeah. And historically, these builders, they tend to trade more like 10 to 15 times earnings when things start recovering. So 7.95, that's scraping near decade low levels. It's just quite a bit of upside if or when sentiment turns.
Okay, so valuation is one piece, but what really makes this a contrarian call, according to the analysis, seems to be Lennar's strategy, specifically this asset-light transformation.
Bingo. That's the core of it, I think. The Millrose Properties spinoff they did back in February 2025.
Right, Millrose. Walk us through that. Why is spinning off properties such a big deal here?
Well, it's not just tweaking things. It's fundamentally re-engineering the business. They moved, $5.5 billion in land holdings, plus $1 billion in cash.
Huge numbers.
Huge. Into this separate REIT structure, a real estate investment trust.
Okay.
So Millrose now handles all that land development, holds the assets, takes on that specific risk. Lennar gets lighter, less capital intensive.
Ah, so it improves their financials, returns, cash flow.
Exactly. Better returns on capital, more cash flow, and crucially, less risk tied to land values and development cycles sitting on their balance sheet. It's sort of like the NVR model, which the market loves and gives a premium valuation to.
NVR, right. Known for that asset-light approach.
Precisely. So Lennar becomes more of a pure-play home-building manufacturer, keeping its scale advantages, but shedding that land burden.
Makes sense. A game changer. Potentially. But, in this market, does operational skill, just executing well, actually matter when mortgage rates are high and things are volatile? Can they really out-execute a downturn?
That's a fair question. And this is where Lennar's scale, being number 2, really comes into play, according to the report.
Oh, so?
Well, look at their Q2 2025 results. Despite the challenges, new orders were up 6%. Deliveries grew 2%. Revenue beat estimates at $8.4 billion.
Okay, so they're managing.
They're managing quite well. Their scale gives them purchasing power, operational leverage, and they have this even flow model. Basically, they keep building at a steady pace.
Even when demand fluctuates.
Yeah, it's disciplined. It means they're positioned to ramp up quickly when demand really kicks back in. It's about building smarter.
And the financials underpinning all this, the report calls their balance sheet a fortress.
It looks pretty solid.
Whoa.
$5.4 billion in total liquidity. Home building debt-to-capital ratio is conservative, only 11%. Plus, they bought back over $500 million in stock just in Q2.
That's shareholder-friendly?
Very. So you combine that financial strength with potential recovery triggers like mortgage rates hopefully easing, the underlying housing shortage.
Which is a big structural factor.
Huge. Decades in the making. Plus, millennial household formation still strong. It builds a pretty compelling picture.
But there are always risks, right? Did Stock Telescope flag anything specific we should keep an eye on?
Oh, sure. They acknowledge risks. Rates could stay high longer than expected, or we could see a deeper recession. Those are real possibilities.
Okay.
But they emphasize that structural housing shortage net formation versus completions near zero for like 30 years plus the demographics, that provides a strong fundamental floor. Multiple paths to recovery, basically.
Right. So, wrapping this up for you, our listener, The core case for Lennar's strong buy rating boils down to a few key things. That compelling valuation sitting at cyclical lows, the big strategic shift to an asset-light model with the Millrose spinoff, and just solid operational execution backed by a strong balance sheet.
And that leads to their price target. Stock Telescope sees it reaching $140 to $160 within 12 to 18 months.
$140 to $160? Okay.
You know, this whole analysis raises a pretty interesting question, I think.
What's that?
When you're looking at a company, how much does really understanding its strategy, its transformation, its operational strength matter? Maybe even more than just the day-to-day market noise or sentiment.
Seeing the difference between a temporary cycle and a fundamental business shift.
Exactly. That recognition seems key here.
A great point to consider. And just one last reminder. This analysis, like all our deep dives, it's strictly for educational purposes. It is not investment advice.
Please do your own homework.
Absolutely. Thanks for joining us on the deep dive today. Make sure you subscribe so you don't miss the next shortcut to being well informed.